In this video, I'm going to go over some of the dangers with delta neutral trading and how delta neutral trading can help you in certain situations. Delta neutral trading is a popular strategy among options traders who want to minimize directional risk and profit from theta in the options market. However, there are some pitfalls associated with this approach that traders need to be aware of in order to avoid losing money. In this video, I'll discuss some common pitfalls of delta neutral trading and provide some tips for avoiding them. There are benefits to delta neutral trading, and one of the primary benefits is that it can help you minimize your risk. And by hedging your portfolio against directional risk, you can reduce the impact of market fluctuations on your portfolio. Additionally, delta neutral trading can help you take advantage of opportunities in the market without having to take on too much risk. So what is delta neutral trading? There are a few key components to delta neutral trading. First, you need to understand delta. Delta is a measure of the change in the price of an option relative to the change in the price of an underlying asset. A delta neutral portfolio has a delta of 0, which means that the portfolio is not affected by changes in the price of the underlying asset. Another key component to delta neutral trading is gamma. Now, gamma is a measure of the rate of change of delta with respect to changes in the price of the underlying asset. A gamma neutral portfolio has 0 gamma, which means that the portfolio's delta is not affected by the changes in the price of the underlying asset. Would like to note, it's literally not really possible to get a 0 delta or a 0 gamma. It's just going to be close to 0, and sometimes it'll be at 0. Now, one common mistake that traders make when trying to create a delta neutral position is using the wrong trade structure. Traditional premium selling trade structures, which can be highly directional and cause significant losses due to a large delta adjustments when an underlying changes direction. When the underlying price changes direction in a back and forth manner and continuous adjustments are made with every move, it causes directional whipsaws. And these inefficiencies can cause losses on whipsaw, just like in directional trading. While traders are trying to profit from theta, they're looking at losses on direction. These losses can frequently outpace the theta decay that was expected from the trade, requiring traders to make up for those losses over time as they book those losses. Therefore, it's important to slow down and diagnose the real problem before trading structures that require large and frequent delta adjustments. Adjusting a position using delta hedging is different than using delta hedging to open and close positions. Some trade structures require legging in to establish and legging out to exit. Opening or closing a position is the time to use large delta hedging techniques as a temporary fix to large delta swings when legging into and out of positions. Personally, on February 6, 2018, I experienced losses due to neglecting delta neutral concepts while exiting my options positions. The previous day's market crash, that was February 5th, 2018, had caused significant drawdowns in my portfolio, but I was pleased to see a $50,000 increase in its value on the next day on February 6th. However, in my haste to take advantage of this turn of events, I closed all my positions quickly without considering delta risk. As I did not use single ticket orders, I had to leg out of my positions, and as I closed one position, the others became directional. Despite believing that I could just close my positions fast enough to avoid significant directional losses, I ended up with a net liquidation value that was minus $80,000, which was devastating. This $130,000 swing was solely due to my lack of attention to delta neutrality while legging out of the positions. So as you can see, delta neutral trading is important, And as you can take significant losses when bad trade structures are used that force too many adjustments, too large of adjustments, or legging in and out. Traders should always consider the correct way to use delta neutral trading. In order to properly use delta neutral trading and adjustments, traders need the proper trade structure and trade plan that focuses on gamma neutrality and super low delta swings, along with single ticket orders to avoid directional legging in and out risk. This allows traders to make low delta adjustments and minimize the need for frequent adjustments, and that reduces the risk of locking in losses. Even advanced traders may not know enough to properly use delta neutral strategies properly. Therefore, seeking out education and training from a high-level, experienced trader can be critical. Numerous trading platforms provide educational resources on options trading, including delta neutral trading. However, it's crucial to exercise caution regarding the trade structures being used. If the structure is a commonly used one, such as like an iron condor, or spreads, or symmetrical butterflies, it may be wise to reconsider. Instead, there are more advanced and relatively unknown options trading structures available that can safeguard against the potential hazards of delta neutral trading. Traders should regularly monitor their positions to ensure that they remain gamma neutral and have super low delta swings. This means analyzing their options portfolio on a regular basis and using tools like delta, gamma, and theta to track changes in their positions. Additionally, traders should have a plan in place for how to handle their remaining positions if adjustments need to be made. By monitoring their positions regularly, traders can stay on top of changes in delta and make adjustments as needed to minimize their risk and increase their chances of success. Additionally, traders can seek out mentorships or coaching from experienced traders who specialize in advanced options trading. These individuals can provide valuable insights and advice on delta neutral trading, as well as other personalized feedback on a trader's specific approach to a strategy. By seeking out education and training, traders can improve their knowledge and skills in delta neutral trading and increase their chances of success. In conclusion, delta neutral trading can be an effective way to minimize directional risk and profit from theta in the options market. However, there are some common pitfalls that traders need to be aware of in order to avoid losing money. And by slowing down, diagnosing the real problem, considering delta risk, using a proper trade structure, plan, and seeking education and training, traders can minimize their risk and increase their chances of success in delta neutral trading. Ultimately, the key to success in delta neutral trading is having a solid trade structure and trade plan. And by following these tips and best practices, traders can improve their knowledge and skills in delta neutral trading and maximize their profit potential in the options market.
If you're a trader looking for trading consistency, if you keep changing your approach, looking to add one more rule that will get you over the top, I'm going to help you for free. Stay with me for the next minute or so. Now, who am I to make this claim? My name is Karl Domm, Karl with a K, and it took me over 20 years to finally succeed to become a profitable options trader. And I have publicly proven to be a profitable trader since I started sharing my P&L on my YouTube channel in May of 2019. Now, my larger options trading account started with $110,000 and now is worth over $165,000. And I'm the only YouTube instructor that shares my daily P&L, proving that I am a profitable options trader. Now, I've asked many other instructors to share their P&L, but they don't because they can't, because they actually lose money trading. And I'm frustrated with the lies being told. If you've ever taken an online trading course, I'm 99% sure that you're frustrated and that you've lost money following these instructors. And you already know that they don't share their P&L. Now, as far as trading myself, I just happen to have a passion for options trading. And I spent over 27 years learning and trading. And I'm not necessarily interested in the technical aspects of options from a scholastic point of view. I've been passionate about the most efficient way options can make me money. And this is my calling in life, as corny as that sounds. And I've even written a book on the subject, even though I hate writing. For some reason, trading ideas just flow into my head all the time, and I take those ideas and I spend hours and hours backtesting them. And after backtesting over 300 ideas, one of the trades I developed was a trade that I call the 2060. This is a proprietary trade I developed almost from scratch. I initially created the course to sell it, and I wanted to compete with these other YouTubers that were frustrating me with their fake claims. But what I've decided is I want to do what it takes to expose those YouTube fake gurus. And if I can offer something for free that is vastly superior to their paid products, maybe I could put a dent in their business, which in effect would be using my talents to help people. Because of this, I'm currently providing the 2060 course at no cost. And this is a full course. It's not a worthless free report or some piece of useless, non-actionable information. This is a full course with black and white rules, rules that you can use to take action and learn how profitable options traders trade. This course is worth $495, but I'm giving it away today for free. See the link in the description to sign up for the course.